Welcome to this video on the legislative frameworks and governance of NGOs in India. NGOs in India are governed by a multi-layered legal structure involving central and state-specific acts. Registration determines the legal status and governance of the NGO, including its ability to accept foreign funding. The primary forms include a trust, a society, or a Section 8 company. We will begin by examining the governing structures and registration acts that define the legal form of an NGO. The Indian Trusts Act of 1882 is governed by the State Charity Commissioner. Trusts are ideal for managing large endowments or immovable property established through a trust deed and governed by a board of trustees with a minimum of 2 members. Public charitable trusts ensure the perpetual management of assets for public purposes, like setting up a hospital. They generally lack the centralized regulatory oversight found under the Companies Act. The Societies Registration Act of 1860 is overseen by the Registrar of Societies at the state level. Societies require 7 or more members to form a memorandum and are managed by an elected governing body. Societies are highly accountable to their membership base due to democratic elections. They must annually file a list of governing body members and are exemplified by organizations promoting local art and culture. A Section 8 company under the Companies Act 2013 is highly credible, overseen by the Ministry of Corporate Affairs, and profits must be applied to the organization's objectives with no dividends. This form is preferred for international NGOs and large CSR funding. Section 8 companies adhere to rigorous accounting and statutory audit standards, require mandatory board meetings, and need a minimum of 2 directors. They are common for large-scale projects like national skill development. This comparative matrix summarizes the 3 primary forms: trust, society, and Section 8 company, detailing their governing laws, regulators, governing bodies, and relative credibility. Next, we will cover the financial and foreign contribution legislations that govern how NGOs manage their funds and receive foreign donations. The Income Tax Act of 1961 grants tax exemption for NGO income under Section 12A and allows donors to claim deductions under Section 80G. Mandatory filing of audit reports is required for exemptions. To maintain tax exemption, NGOs must apply at least 85% of their income to charitable purposes in the relevant financial year, known as the 85% rule. The Foreign Contribution Regulation Act, or FCRA 2010, is governed by the Ministry of Home Affairs. It regulates foreign funding to protect India's sovereignty, requiring mandatory registration or prior permission and detailed annual returns. Mandatory FCRA provisions require that foreign funds must be received only in a designated account at the SBI New Delhi main branch. Aadhaar is mandatory for key members, and strict transparency rules apply. The FCRA 2020 Amendment Act restricted the utilization of foreign funds for administrative expenses to a maximum of 20%. Finally, we explore other relevant legislations that impact NGO operations. The Goods and Services Tax applies if NGOs engage in commercial activities exceeding threshold limits. The Prevention of Money Laundering Act, 2002, prevents the misuse of the NPO sector for illicit financing. Labor and employment laws, such as the Minimum Wages Act, Employees Provident Fund, and Payment of Gratuity Act, ensure fair compensation and benefits for all eligible NGO workers. In conclusion, adherence to rigorous compliance and transparency is non-negotiable for the effective and sustainable operation of any NGO. Thank you for watching this video. The image sources are listed here. This slide lists additional image sources.